Sure. So, welcome everybody to this month's Thrive Talk. Peter Culver, co-founder of Wealth Thrive, and Kyle Cain, our chief investment officer. After 2 years of tremendously solid returns in the market, obviously this year we've been experiencing new volatility and a downturn in the market in the first quarter. So, we want to dig into why it's happening, what should investors be doing about it in some detail. Our basic agenda for the call is as follows. On the next slide, Thresha. So we'll talk about where we currently are with the tariffs. How's the market reacted? This is important. We want to put all of this in historical perspective. It's easy to get caught up in the moment and sometimes make bad decisions based on what's just happening in the moment. Obviously, a key consideration in all of this, especially with Trump's latest actions, is how the Fed factors into all of this. We'll look at some scenarios. Kyle will unpack a couple of scenarios that might happen in the future. And again, what should investors think about that? And we'll talk about what we've been doing in our portfolios. So, Kyle, maybe let's start by unpacking in a little bit more detail what's actually been happening with the tariffs and other things that have been impacting the market in the last 3.5 months.
Yeah, so, we'll say where we sit today is certainly quite a bit different regime than what we've been used to, right? Last year, effective tariff rates were about 2.4%. And, Trump has obviously, said throughout the entire campaign trail, tariffs were going to be a big part of his agenda. However, right, the markets weren't really pricing in what we saw. The markets were, sort of pricing in more negotiated, targeted approach to that, and instead focused more on sort of the tax, potentially being able to get tax cuts and deregulation and some of the more growth-oriented policies. So, we got Liberation Day when we had that whole formula with tariffs that went, across the board on every country, and it was, let's say, very, art of the deal, sort of his book on how you just kind of throw these wild numbers out there as a, negotiating standpoint. And then when you kind of get what you really want, the number looks a little more reasonable. I don't know if that's the best way to have handled the situation, but that's what we got. So, markets obviously didn't like that, sold off pretty aggressively, and then we got the 90-day reprieve. So as we sit today, there's about a 10% across the board, tariff rate, while that 90-day reciprocal tariff is postponed for negotiations. Some escalating, trade issues with China has pushed that effective tariff rate to 145%, and they've retaliated on us. We still have the 25% steel and aluminum tariffs, 25% on autos, although Trump's made some comments. I haven't seen anything official, but made some comments that there could be some flexibility there. And then also we got some exemptions on some technology imports. But the main reason that was done, one, is the pain that the markets were feeling a little bit, but also they want to put that under a Section 232 tariff agreement where it can be a little more permanent than the reciprocal tariffs are done. We also have 25% on goods from Canada and Mexico that aren't part of our U.S. Mexico-Canada agreement. And then 25% on potentially countries if they buy Venezuelan oil. So, basically what we're at right now is, we're down from where the effective tariff rates were immediately post reciprocal tariffs, but the effective tariff rate is significantly higher, still probably like 20%. There's a lot of uncertainty on where that's at because it's, again, with China at 145%. The question is, can companies find substitute goods from China and go to India or go somewhere else in the time being to avoid the 145%? Some things they can, some things they can't. So the exact number is hard to say. But let's just say again, I don't think anyone thinks things are going to stay exactly where they're at. But where they're at now, that could easily, you know, raise costs for families, like a family of four, between $4,000 to $8,000 a year, right? So it is a hit on consumers, hit on business profit margins, et cetera. But that's where we're sitting at right now, with the hope of some negotiations to come.
So I think, Kyle, before we go on to dig into that a little bit more and likely scenarios, let's put that in a little historical perspective, right? So let's a little bit of a busy slide, but why don't you, for the benefit of the listeners, we want to gauge this drawdown in light of things that have happened in the past, not just in terms of what's happened in the last 3 months.
Yeah. So like I said, at the beginning of the year, markets still performed well. We started the year with some pretty good momentum, economic momentum, good consumer spending, a lot of the hard data. There's questions on potentially some of that might have been softening to begin with, starting this year before the tariffs were put into place. But nevertheless, right, the markets now, the S&P 500 is down today about 10% from the start of the year, about 14% from its all-time highs. Small cap stocks, which have been hit a lot harder. Which, again, there's some reasons beyond that. They have a little bit less foreign sales, but also they're more susceptible to a slowdown in economic growth. And that's kind of the concern right now, is the growth scare that's happening in the markets. So they're down, about 16% year to date, or 20% from their highs. Growth stocks are down about 15%, versus value is only down about 5%. Tech is down about 20% from its all-time highs. The Mag 7, which has led most of the returns over the past couple of years, they're down 23-ish%. Semiconductor stocks as a whole are sort of down about 35%. So point being here is just to kind of put this in perspective of, right, there has been a significant sell-off, and I'm sure all investors have felt it in their portfolios, and there's concern on where does it go from here, which we'll unpack under this. The main thing to sort of take away, or a few takeaways, is valuation. So far, it's been mostly valuations kind of coming out of, we're trading at about 23 times forward earnings. Right now, we're, after today's little rally, about 19 times forward earnings. Earnings projection for the next year, was about 15% coming into the year. They've already came down to about 10%. They'll likely be revised lower, as some of this works its way through. But there's been other areas that have helped. So I'll talk about the historical here in a second. But gold is up 29%. International, Europe, and EFA indexes are up 8, between 7 and 10%. Bonds, we talk about what's happening with interest rates and where that could go, but they've still provided some support year to date. So, right, let's talk about this chart here. What this is trying to show is, right, we've had a pullback. Like I said, 14% from the all-time highs. So far, it's nothing to be alarmed with, and you'll see where this kind of circles back when it goes to really what I'm sure most people are concerned about. What should they do about it? It's not that severe. So could it get worse? Of course. However, let's put it in perspective, right? This is kind of par for the course as far as volatility goes. We get a 5 to 10% pullback several times a year historically, and we get a 10 to 20% pullback in the markets about one every 1.8 years. So, if 2 years go by without close to 10 to 20% pullback, it's due. It's due to happen for some sort of reason. The question goes: is those corrections, do they turn into recessions? That's the $1 million question. If they turn into a recession, then historically the markets are down around 30 to 35% from peak to trough in a recessionary market. However, that being said, like I said, we get a 10 to 20% correction, at least every 2 years, and majority of the times those don't turn into recessions. About 56% of the time they recover, within a relatively short period of time. If we get a recession, of course, it's going to take longer, but it's the same thing. It's still going to recover. So this chart here is to show, we've gone into recessions. The 2022 wasn't an official recession, but it was kind of what we say like an under the surface recession. Certain areas like the housing market and commercial real estate and certain banks and things like that, they had sort of recessionary implications, and the market sold off 25% or so, but we didn't go into recession. And the point of the chart here is look how quickly it recovered significantly, within just a matter of months, really, from that perspective. The 2020, pandemic, right? It's a self-induced, sort of like where we're in now, drawdown in the markets. And it was also, right, or something like quickly resolved. So I guess the main takeaway here is not to panic, right? Things could get worse. Historically, though, right, when you buy if you were to back test what to do in the markets, and you were to say every time the market sold 10%, you bought, instead of trying to wait till it went down 15%, or if you waited till it went down 20%, you would have been better off buying at the 10% level. And, because it's so hard to time, that ultimately what I'm trying to get to here is that when the things seem the worst, that's when the markets will already be recovering, right? Like the markets recover before the numbers get better. So like I said, economic data hasn't been hit too hard yet. We'll probably start to see economic data come in lower the next couple of months. But by that time that data is really baked in, the markets could have already started its recovery on the way back up.
So I think there is a tendency in an environment like this, Kyle, to see if you can kind of tap into it with perfect precision and get out at a certain point and then get back in. And we just have a little slide, and maybe you could talk a little bit about it's difficult to time the market accurately and be successful at that. So if we look at the next slide, there's some data there which maybe you could talk about.
Yeah, so I mean, obviously this, just look back a couple weeks, right? When the April 2nd tariff announcements came on, the market sold off 10% plus in just a couple of days. And then all it took was a tweet saying 90-day reprieve, and the markets rallied 8% in a day, or had one of its best up days. So, right, especially and almost at any time, right? Again, I know it sounds cliche, but it's like time in the market beats timing the market for majority investors, because it's true. Like I said, buying at the 10% dips, back tested, usually does better than trying to wait to get in, even cheaper. So these are our tried and true, lessons for a reason, because whenever we have like significant bad days, again, it's usually within a couple of weeks that we see huge upsides, and you don't want to miss those, right? This whole chart, which I'm sure a lot of investors have seen before, it's the, just how much the value would have grown versus staying in, versus if you got out after some of the bad days and you missed those big up days, and how much less of return you're in. So again, timing it is certainly hard, and you have to think about it. Again, we hit about a 20% sell off, like I said, about 15% from the all-time highs now. we hit about a 20% intraday. We didn't technically go into a bear market because the market has to close at 12% or 20% below its all-time highs. Um, but right, if you buy at those levels, right, you're guaranteed to get a 25% return when the markets do inevitably come back, to all-time highs. So it's a pretty attractive entry point when you put it into perspective.
So, Kyle, obviously the question on everybody's mind, and we don't have a crystal ball, but what's going to happen next? And I think you've thought about a couple of different scenarios, depending upon how the markets and the economy act going forward. So let's walk through those. I think the first one is what you call your bull case. So on the next slide, let's take a look at that, and maybe you could unpack this scenario for our listeners.
Yeah, so, I'll say that obviously there's tons of different unknowns, right? There's a bunch of known unknowns at this point in time. Right now, right, the markets are hyper focused on negotiations. Like if we see, like we just get a couple, Trump administration get a couple wins under, you know, to declare they made a deal with Japan, right? The markets are probably going to like that and rally quickly. Hence why you don't want to be selling, even though there's still, like I said, which I'll talk about here in some of these cases, there's still the case that we go into recession. You don't want to risk it. When every time there's a one individual pulling into self-induced sell-off, and it could be undone any second, it's probably not a good idea to sell. It's better to kind of just use the sell-offs as a buying opportunity. That said, right, we don't know how much, like I said, how much is there going to be substitute. I think the big case is, right, yes, Trump wants to negotiate the overall, kind of global trading system as we know it, but China's the biggest offender, and that's ultimately at the end of the day, right? He wants better deals from everyone, but it's ultimately trying to move away from China. So how easy is it to do that? That's a hard thing to figure out, right? We can't just build, um, new manufacturing plants overnight. Not, every country is set up. Certain things are just coming from China. So it's, questions on how can we find substitute goods? How much will the exporters absorb versus how much will get passed on to consumers? How are consumers going to respond after coming off inflation over the past couple of years? Are they going to push back and really tighten the belts? Have they, have their excess pandemic savings been pushed through, right? And how much cost cutting then will businesses do to try to, if things are slowing, to offset some of that profit margins, and does that lead to more job losses? And I'll say chances are, in majority of these scenarios, there's going to be a little bit of a hit to earnings. However, the bull case here we're talking about is, let's say we start to get some of those wins and we see some negotiations happen relatively soon. The markets probably like it. We can then obviously work on China being the big one, figure out something there. See a few more companies agree to invest in our invest here in the U.S. Right? And ultimately we're kind of unwinding, and if we can get to an effective tariff rate of less than what the markets are sort of pricing in, like I said, the markets are sort of pricing in, about a 40 to 50%, recession risk at this point. Not everything's priced in. Some of it is, and they're, pricing in around a 10% effective tariff rate. I would assume. So if we get something less than that, we could easily see quickly the markets, have now certainty. Businesses can kind of go back to, have an idea on the game plan, how they can manage this. Then the markets start looking past tariffs. Now that we know what it is, it's not as bad as expected, and we can focus on tax reform, deregulation. In that scenario, right, markets could rally quickly, be up 20%, in a short period of time, and and continue higher from there. Right, you'll see I put a 20% because I think, it's an optimistic scenario. I think that chances are negotiations are going to take a while. So that'll take us kind of to scenario two here.
Right. So
This,
this I
this is kind of, yeah, this is sort of like the scenario that to me is the most likely, which still there's plenty of, I could put in here a million different um, potential different, scenarios that happen inside of here, but ultimately trying to move in the same direction is it takes a little bit longer to get negotiations. It's not a foregone conclusion that after the 90 days we don't put reciprocal tariffs on other countries, right? Especially if we see that China is just rerouting its goods to other countries. And we, to stop that, we have to impose higher tariffs on other countries. That wouldn't be good, right? So my point here is that this is kind of assuming that we do get some deals. I think the most likely is we will strike some deals. Um, Obviously, the biggest trading partners are Canada, Mexico, China, Europe. If we can work something out with them and have the effective tariff rate somewhere, again, I think there's a good chance that maybe we leave on the 10%, tariff rate, and then we have China a little bit higher. I think a lot of, I think businesses can navigate that environment. It's definitely going to hurt. It's going to increase inflation. It's going to hurt, consumer spending. It's going to hurt earnings. And then just how long it took and businesses not spending, be able to figure out what to do, likely would, kind of put us into that bear market scenario. Markets go down to 20-25% sell off and then starts to recover. um, Takes a little bit longer of a recovery than in the first scenario, but could still easily recover in a year or something like that. So I think, there's a lot more I could unpack in that type scenario and how different things could play out. But I kind of give that my 55% chance or like the highest likelihood case scenario. And which I didn't really say in the bull case, right? Like if you thought the bull case was going to play out, what would you want to do? Want to be right now buying tech, and you'd want to buying small caps and all the things that have sold off the most, right? Because all the pain that's been priced in isn't going to be there, and and things go right back up. In this type of scenario, which we'll kind of get to on what investors should do, right? It's more playing a diversified approach to it, right? Knowing that things could get a little bit worse, keeping some of the safer value-oriented dividend, type stocks balanced with some things that sell off a little bit too much and became cheaper. And then let's talk, scenario three, right? Which is obviously the questions we get all the time is recession. Um, you know, whether it just takes, even if we get negotiations, could a recession still happen if it took too long? These types of things, yes. Right? Like, again, at the current effective tariff rate we're at, the economy already slowing. I think, especially if we get, thing can come to the table and we see some more retaliatory tariffs come from other countries, right? You kind of get that self-fulfilling, cycle of businesses having to cut, reduce, reduce employment that further slows consumer spending, and you kind of spiral into that recession, right? Like I said, which I already talked about earlier. In that environment, right, markets could sell off 30+% from kind of the peak levels. So we're about halfway already to recessionary environments with the current sell off. So there still could be more to go in that type of environment. Again, there's some things we didn't talk about on the bonds and interest rates being higher, um, but the Fed would be able to cut, if we saw employment really start to be impacted. And then what I try to, talk to people is price this out. Like what could happen? That's no one wants to lose 35%, but the point is where going into recession matters a lot on the starting point. All right. Like, so valuations were high. So you could see still that 35% sell off in the stock market because you're starting from a high level, but the economy wouldn't be hurt as bad as in previous recessions. There's no bubbles out there. The businesses are, in great shape. Their balance sheets are amazing. They have, their debt service cost ratios are fantastic. They've got tons of cash sitting on their balance sheets that they're earning, high interest rates on. They have, all-time high profit margins, so they can withstand this pain. And they'll be reluctant to lay people off because they knew how hard it was. So we could see unemployment rise, but not anything crazy. And consumers, for the most part, right? We know that some lower end consumers are stretched, obviously, after inflation, and housing prices are out of reach for a lot of, the lower income consumer. And of course, if the stock market's selling off, there's that wealth effect of the higher end consumer feels, like they're not worth as much, so they may cut back on spending a little bit. But overall, right, like, you know, majority of U.S. consumers have their home that, that 3 to 4% mortgage rate. They're certainly, when you look at the income to debt levels, where the average consumer is in a good place as well. So there's no bubbles. So it should be a relatively shallow recession. Um, and again, it would just be a great buying opportunity to take advantage of things that have sold off. It could take now in that environment over a year to recoup some of those gains. It could take a couple of years, but again, it's not a great scenario. But I think, again, in my base case is we're able to just kind of stick through and avoid that full on blown recession. So I give this one about a 25% chance, right? Obviously, these numbers can change any day based on new data that comes out. My likelihood, but that's kind of where I'm where I'm thinking right now.
So you mentioned briefly, it's gotten a lot of press in the last couple of days, the Fed. And so maybe unpack a little bit. Trump wants the Fed to lower interest rates. Is that a good idea, a bad idea? How should we follow that conversation, and how should that impact how we're thinking about our own investments?
Yeah, so the Fed's in a tough place, right? His tariff is gonna increase prices. It's gonna get passed along somehow, and so we're gonna see greater inflation from tariffs. And right, and you think about not too long ago, the 2021, 2022, Jerome Powell was sort of behind the curve on raising interest rates and thinking that it was going to be transitory. They don't want to make that mistake again twice. So cutting too preemptively in an inflationary environment, is a risk. But at the same time, obviously, tariffs slow growth, and that could, and we're already, again, we're starting to see it a little bit in the data, but we're likely to see it more. So obviously, Trump wants to, which every president wants, though, is that they want lower interest rates, and then even if it causes inflation, that's the next administration's problem, right? Usually, sometimes it takes a while for all that to follow through. Um, I would say, right, the Fed has that inflation mandate, has the employment mandate, also that the markets function a little bit. So I'll talk about like the employment and the inflation mandate, right? Like, so they're in a tough situation. I think the most likely scenario is, right, they hold in May or so. I think the markets are pricing in about 3 to 4 rate cuts this year. Um, it's hard to say exactly what they're going to do. I think a lot does depend on the job market. If we start to see employment slip, they will be able to cut rates. The other flip of the coin with Trump wants to see lower 10-year rates. Well, if you kind of see what happened with the 10-year bond, was at about 4.8, thinking about U.S. exceptionalism and the growth that we're going to have and higher deficits. And, so we had about 4.8%. And then when the tariffs were announced at the levels they were, the growth scare kind of came in, and 10-year treasuries sold off to about 3.8%. Now today they've moved back up about 4.4. And so the narrative has just shifted even greater on, is the U.S. exceptionalism done? Is the dollar, Trump wants a lower dollar and looks like he's getting it. The dollar sold off about 10%. So, there's concerns about, there could be more devaluation of the dollar. Then there's the whole, again, I won't go into the whole thing, but the current account versus capital account deficits and how we send money and the rest of the foreign, governments take all the, all our, the money we're sending buying their imports is coming back to us into our treasury markets and our stock market, and there could be less foreign demand. And there's even the thought of could there be, right, that weaponized and China and Japan start selling off our treasury. So interest rates have moved back up. So I'll just kind of say most of those are not worried, are not, shouldn't be of too much of a worry. Yes, could there be a longer term dollar devaluation? Could there be less demand? The biggest thing the US need to do would be to reduce our deficits, which likely isn't going to be happening. But there is, our reserve status, the US dollar isn't going anywhere anytime soon. Might be again a gradual depreciation of it. Um, there's going to be demand for our bonds, and the Fed has room to step in. So, like I said, the third part of sort of their mandate is to make sure that there's a well functioning um, market, and so they would step in if there was any liquidity issues or things like that. So, I guess my answer to this is it's a tough situation. The Fed can't just come into the rescue immediately, but they will. There is a Fed put in place if we do see some of that recessionary or just the job numbers start to get hurt. And being at such a high rate, know that if we do go into deep recession, there's a lot of room for them to cut, right? They can cut, they can cut 3%, and versus, if you look back not too long ago when, the Fed funds rate was zero, they couldn't do anything. Now we have room. So that would stave off that, when I go into that recession scenario, that would also make sure that there's not a really deep recession this time around. And then the last point is, which I'm sure everyone's thinking was the Fed independence, right? Like, yeah, I mean, obviously that's not good. That would push the dollar down further. That would push, if Trump came in and was able to fire Powell, because they said, oh, every president wants to not necessarily do what's the best for those dual mandates. They want what's doing best. Like, hey, let's spark the economy now. Let's cut interest rates. Let's get things going. Let's worry about the inflation down the road. We don't want that, right? I want, a separation of power, someone to work separately. I don't think, right? Again, it's who knows. Either way, like I said, it's not a huge concern. If he did, they can't, if he got rid of Powell, that's not going to mean that the FOMC is going to change their their rate cutting, cycle. They still have to vote on it and still make the determination. It could obviously expedite it, and at the end of the day, right? Even if we had to have a higher term premium and things like that, there's going to be enough demand that it's not going to, be a dysfunctional market, and we'll be able to recover from it. So, bottom line, tough spot for the Fed, but ultimately a Fed put does exist if things get bad enough.
So maybe let's talk for just a minute before we open it up to some questions about what we're doing in portfolios. And I thought an interesting way, I'm going to give you a couple of scenarios, different client situations, and what would you be doing? Should the client think about it? So my guess is in our client base, we have a bunch of clients. They've got portfolio, they're retired. Some of it might be in an IRA, some of it might be in a personal account. It's all they've got. And they're probably, notwithstanding everything we've said about history and don't time the market, they could be concerned about the ability of their portfolio to last. So how would you talk to a client like that, and what changes, if any, might you make in their portfolio?
Yeah, so it's a great question. I mean, I would say, like I said, different investors warrant potential different outlooks, and you have to look at it from two perspectives, right? You always want to look at it from the long term perspective on what's going to be the best for you. But at the end of the day, also too, I compare myself to the S&P 500, and so I want to do better and protect on the downside too. So long story short, right, an investor like that, right, the main thing is to always regularly, again, it's going to sound cliche, but it's like go over your financial plan. What is your cash flow needs? What is your need? How much time could you buy? We know that recessions are going to happen. You go in any year, there's a 25% chance of recession. So map out beforehand those scenarios on would you be able to withstand it, and make sure your plan is set up, accordingly, and that you've done that kind of gut check that you're able to withstand it, right? Obviously, the worst thing to do is it's down 10%, you sell and you miss out on those returns that we said before. That said, right, once you've done the financial planning, you kind of realize you have enough in safer assets, cash. Again, in a portfolio like that, we have still plenty of cash, we have plenty of bonds, plenty of safer gold, things like that have done well, that we can pull off of to supplement their income and not have to be forced to sell those stocks in the down market. I will say that, I personally, in all of our accounts, right, did some to prevent on the downside. I sold out of probably about a third of all our small cap exposures, just because the risk return didn't make sense to hold them, right? If there's a flight to quality, or if there's, the tariffs go on, there could be a deep recession on the small cap stocks. So it just wasn't, didn't make sense. But did I want to sell the Mag 7? No. I mean, like I said, they're down, 23% or so. But if, right, and like obviously we use Apple as a good example, right? Yes, if there's no exemptions for them whatsoever, and they're hit by 145% tariff on China, and then let's say whatever the one on India went back to it, they're going to get crushed. However, what's the most likely scenario? Apple just, he said they're going to invest $500 billion into our market. They're going to get some exemptions. You're buying these companies now at still not cheap levels, but relatively cheap levels that have huge balance sheets that can withstand. So you might all of a sudden see a flight to quality, and just like we saw in previous sort of market sell-offs, where the Mag 7s lead things again. So, my point there is, yeah, in that scenario, it's, even it's cliche, it's, if you have someone that you trust to make some of those decisions on what positions to hide in, get a little more defensive earlier on, do it at the margins, right? Sell a little bit of equities, a little bit of things, but don't derail your entire financial plan. Hopefully you had that, that game plan going into the stress.
So let's take the other extreme. It could be a young person who's making good money, socking it away, doesn't need the money now, or a long-term trust. Are we buying? Are we still treading water a little bit? How would you advise someone in that position to react to the market environment we're in?
So yeah, in that environment, it's completely different, right? Because you have to take the longer term approach. Um, you know, so the answer is I'm a buyer. I'm a buyer at these levels for them. Someone has a lot of cash. Like I said, even though my base case, if you kind of saw it, if I put those weighting odds, is that we still go down another 10%. It's not worth it to try to time it and wait for that. Because again, if you just look at right now, like semiconductor stocks, right? They said they sold off 35, 37%. Yes, they're still trading at like 30 times earnings. And but if you and people are obviously concerned about the deep seek and it not costing as much, and chip export controls is there's big issues. But at the end of the day, right, and that could take some big hits on Nvidia and things like that in the short term. But in the long run, right, it's 30 times earnings. Like expensive for a sector that potentially is going to have 20% earnings growth every single year, if not greater than that for the next 10 years, Probably not. If you start to look at what's the PE ratio in 2 years and 3 years out, now you're sitting at, like a 15 times earnings. And so it becomes pretty attractive. So my point is, we may see more things sell off. Have your shopping list ready, right, of companies that you like. Again, that sold off too much. I won't go through all the different scenarios, but there's plenty of nothing's like a screaming buy, but there are plenty of things that are going to pay off down the road. Let's see, it's like dealers and things like that have sold off tremendous because of auto part tariffs and things like that. But they're pricing in already like a 70 to 80% recession, versus the overall stock market's only doing a 50%. And ultimately, right, if cars are going to be more expensive, even though the auto parts are, going to be a little more expensive too, more people are going to have to fix their cars than buy new ones. And so they could, benefit in this type of environment when you're buying at such cheap levels.
Right.
Importing, you think about like cloud could continue to do well in this type of environment if, companies who prefer to keep their data at home on their servers versus, outsourcing to the cloud, will now to get new servers, get new data centers for themselves are costing that much more from tariffs, then the whole cloud case makes that much more sense. So cloud could benefit. So at the end of the day, I said it makes sense for those investors to start buying. Maybe have again a preset target on, if things hit certain levels, I'm going to put X amount in. But like I said, nothing's a screaming buy, but there's plenty of good things. Muni bonds, right? Again, we can talk about what's happening. Muni bonds have sold off quite a bit. They're negative on the year based on term premiums going up and economic slowdown going, but also which was kind of thrown around out there, the idea of to raise revenue for them to lose their tax exempt status. And, so they've sold off quite a bit. I would give that as a pretty low chance of happening, that they're gonna lose their tax status. So you can get 7, 8,
Right.
9% tax equivalent yields on munis that are super safe and are going to continue to pay you. So there's opportunities out there to put your money to work.
So before we open it up for a few minutes for questions, I'll just mention two things. One is Kyle emphasized the importance of planning. And what we've been doing with a lot of our clients is either going back to their original plan, financial plan, or help build that. And using the e-money software that we use, we can stress test a portfolio and consider it under certain scenarios. If you'd like to have us, in addition to doing that planning analysis, to actually take a look at your portfolio, if you just take a photo of this QR code, there's a very short form that you can fill out, and we'd be delighted to do that. From an educational perspective, if there's even more you want to learn, Kyle's written a great book about how to deal with this market and lots of other markets. We'd be delighted to send that to you as well. But let's please open it. Happy to open it up for questions. You can put your questions in the chat. You can go vocal and ask your questions, but certainly happy to answer any questions from those on the phone that we haven't addressed so far.
Peter, I'll ask a question for you. So even in your career, you've been in the markets for 40 plus years now. From your experience, how do you handle the panic? Because it's easy to talk about things, but when you're in it yourself and seeing your account go down, it can cause some anxiety. How have you navigated it over 40 years?
So I guess because I have the 40 years under the belt, I know what that chart that Kyle put up. And so I think part of that's intellectual, and part of that is just maybe a fortunate personal temperament. But I know I'm not smart enough to time the market, and so I hang in there. But I do the things that we're talking about, which is I have a financial plan. And when we get into an environment like this, I think about, is there a risk that this, might hurt my financial plan? And the most important thing I do is Kyle manages my money. So that gives me a great degree of confidence in what's going to happen in the future.
Yeah, one of my favorite slides that that I have or put together or seen before is right. It basically lists, you can choose whatever time frame you want, but let's say past 20 years or something like that, and it just says some sort of major event that happened that year. That if you read it, like Russia invading Ukraine, or or something like that, like something you're like, I read this is going to happen this year. Would you want to invest? And you read these headlines, you're like, no. But then, right, what has the market's done over the past 20 years? It's compounded at like 13%, compound annual growth. So we're in another one of those environments where, yeah, the whole, things could significantly change on how, how global trade sort of works and things like that. But, what's kind of one true is that businesses figure out a way, right? They figure out how to navigate, still create productivity. AI is, just now that much of a catalyst for them to be able to improve their profit margins, increase, productivity. So, right, I'm still very optimistic over, this next decade. We're going to have, great innovations and a great performance.
Other questions?
And with the question, isn't this time different? That's I think that's what we keep hearing, right? It's
yes and no.
This has never happened before this way. So what's your answer?
No, but it is different. I've never seen anything quite like this in my career, and most people haven't, since we haven't had tariffs, for past 100 years of this sort of magnitude. However, that can be said about so many different things, right? Like, remember 2008, which is, certainly one of the worst recessions, the great financial crisis. Obviously there was doom and gloom that the entire monetary system was going to collapse. There's always these things that this time is different. We're not going to get out of it. But at the end of the day, again, you put all the pieces together of, again, whether you think how much role government should play in it, but, lower interest rates, fiscal spending, and then at the end of the day, businesses just being, and consumers, everyone just being resilient and being able to figure out a way. You have to take every scenario as an opportunity, and there's always something that you can be doing to when you come out of the other side, which you inevitably will, to benefit from.
Kyle, you spoke a little bit about the Fed and the pressure that Trump is putting on. Do you think the pressure from Trump will impact Powell's decision making with cutting rates? I know you spoke a little bit about it. Or do you think Powell will stick to his method? And then the second part of that is Powell, do you think he's likely out of a job? I mean, the comments from Trump seems like he doesn't even really want him there. And what does that mean for investors, for us?
I mean, so I'm still in the camp that no, like it's not going to get that extreme. I think Besant is in his ear. He doesn't think it's a good idea. He has some people in there that's telling him like he wants to do it. Yes, he would love to fire him, and he wants that power. Obviously, he let go some other members, and whether it's legal, and we'll see what the Supreme Court does once it gets escalated through theirs. But at the end of the day, my guess is no, he doesn't get fired. He's got about another year, May 2026. Right. As the Fed chair. He'll still stay on the board for several more years after that. I don't, there's no way to know on whether if he cuts rates in May or he cuts rates in June, was that influenced by Trump or was that influenced by the markets, right? He's not going to ever let on that it was influenced by Trump. Right. Like yeah, cutting rates is a good thing, right? And again, it could cause inflation, but it's a good thing. So if he does, great. If he doesn't, I completely understand why not. And we've kind of proven that where rates are currently, the economy can still thrive in a 4%, Fed funds rate type environment. And we just know that, right? So if he doesn't, we can still manage through it. But if things get bad, he will, right? If the economy does suffer, he will cut rates, and then we have that Fed put, and that'll spur, spur economic activity with lower rates.
Thanks, Kyle. Are there any other? If not, sorry, go ahead, Peter. We can go to the.
Go ahead. No worries.
No, we're good. I think if there's no questions, we'll go to the next slide for the registration. I'll give it back to you, Peter and Kyle. Thank you.
Sure. So again, encourage everybody interested in the topic we had today. We're happy to do a detailed evaluation of your portfolio. Happy to work with you on your own financial plan to give you what Noah and I like to call the 2 C's, which is clarity and confidence about your investment plan. And a lot of that is about discipline. And so we want to encourage you to, join us on our next Thrive Talk. Our wonderful colleague Jenna had I don't know if pleasure is the right word. She'll tell us on the talk. She had the good fortune to work at Bridgewater, one of the great investment firms. It is a highly disciplined organization, which I think she'll unpack that in more detail, but it certainly contributed to its success, both in managing investments and in the growth of its organization. So there'll be some great lessons for all of us in that, and you can sign up and register for that by scanning on this QR code. And certainly appreciate everybody joining in. Hope this was valuable, but reach out anytime if you have a concern or a question about the markets. And a big thank you to Kyle for taking so much time to share his wisdom with us today.
My pleasure.
Very good. So we'll see everybody in a month.
Thanks, everyone. And that QR code, we'll keep it on for 60 seconds so you guys can register for next month. And if you want to do the portfolio review with Kyle, that link is in the Zoom chat. Just click that. You can download Kyle's book and you can register for a portfolio review. Thanks, everyone.